Hi everyone. Okay, so this is a crucial topic because everybody is always feeling right now at this time. We've kind of got the stock market creating all-time highs, and Bitcoin's been doing really well, and Tesla's going really well, and so we are in a bubble. The first clue that you're in a bubble is when everybody you know is talking about stocks and they're involved in it. That's the kind of first clue that we have. I'm just going to adjust my camera here. And so that's the kind of first clue. And the problem is I regularly hear people getting upset when the news comes out about a particular stock, and then it's positive news, but then the stock price drops, and they're incredibly confused because they think that the market has to behave in a rational, orderly fashion. And actually it is in its own way. It's just not correlating with what they think order is. Okay. And so the problem with this is that they'll be doing the same thing in 10 years time. They'll still have the same approach to the market, and the thing is that we expect the market to always correlate to our expectations. So one of the things, so this is a series of videos that I'm going to do, and I want to keep them into short bites. I'm already talking too long on this stuff, but the first thing I want to talk about is the difference between trading and investing, and this is one of the key reasons why people repeatedly lose money in the markets. So the first thing is that they're confusing. They don't understand the differences in between trading and investing. They are not the same activities, and they are vastly different. And the consequences of mixing and matching the approaches and the philosophies and the strategies results in consistent losses in the markets because you're out of sync with the markets. And so this is very important to distinguish the difference between these two. So let's just start with the idea that investing is a passive activity, meaning investing is when we have money that we do not need to use right now, and we want to put it aside instead of into an interest-bearing account at a bank or a high interest-bearing account. We want to put it into something like a property or into a stock, something that we feel we don't know when we're going to need the money back, but we know it's not going to be in the next 6 months to the next year. The point is there's no pressure, and we don't need that money right now. It's savings, but we just want it to increase in value, and so we put it aside for an unknown kind of period of time, but it's going to be medium to long term. And so in that particular situation, we are not in a rush to get it back, and therefore I say it's luxury or it's a passive activity. And often what happens is that as long as it's increasing in value, and if we're lucky and there's a bonus and there's dividends coming out of it, or if it's a property we put it into and we're getting rental income, there's this additional cash flow that we get from this, and that's an investment. Okay, and so what happens then is as long as we don't need that money back, we can just continue to leave this to continue ideally to increase in value over time. Part of the success from that comes from, yes, selecting the right instrument, and largely timing. We just don't want to overpay for it. But that's important because it means that as long as we feel the price is roughly fair, we're in. We don't have to have it at a very, very specific price, just within a band of price that we feel is a fair price. That is the first thing that we need to understand. And so what happens is, in trading, it's very different. In trading, we have a very specific price point at which we are getting in to a specific pip or point. Precisely, nothing more, nothing less. That's exactly where we want to get in. All right, and our timelines are vastly, vastly different. Trading is when we need to earn an income, as opposed to it being passive or luxury, whether it's open-ended. We need to earn an income by the end of the month. That's a very different approach. I'm only concerned with what the markets are doing today or this week. My window, my time frame for those opportunities is just right now, and that's it, and not beyond a certain point. And therefore, the person who's investing is thinking perhaps longer term. Where do I think gold is going to be over the rest of the year? Where do I think cryptos are going? Where do I think this particular stock is going? A trader is going this week. Is gold bullish this week, or is it bearish this week? I don't really care where it's going to be 6 months from now. I really do care if there's a potential high probability trading opportunity right now, shorter term. I'm in and then I'm out, and this is hugely important because, and this leads me to point number 2 in terms of this idea, is that there isn't necessarily an exit point with an investment. In theory, if you take Warren Buffett's approach of value investing, as long as this particular instrument or my investment continues to increase in value and I don't need that cash, then there's no reason for me to exit this particular investment. As a trader, you literally cannot count on that money, that profit you've made, until you exit that position. And because you have to feed yourself at the end of the month, and you do this as a day job instead of anything else, you have to exit that position. And so what happens is folks kind of jump between the two. They get in on a trading idea, but then extend it to investing and then take their stop loss out because they're like, well, I'm thinking long term now, and they shift between a short term and long term approach. They find themselves constantly out of sync with the market because they got in and out for completely different reasons and actually jumped strategies without even thinking about it. They jumped everything, they changed everything. And so as a trader, there is a definite, without a doubt, exit point. And if you do not have a fixed exit point with every single trade you take, you cannot consistently make money. So that is a starting point that I want you to think about. And then in the next video, I'll talk about other stuff. But this is definitely something. So if you don't have a fixed exit point, you are screwed. So in trading, fixed exit point. In investing, possible exit point, possible not. Okay, those are vastly different approaches. And they affect timelines and where we get in and where we get out.